Next point on this part, there's 4 income splitting strategies we want to cover. Hopefully these will help you. So in Canada, we have a progressive tax system. The more income that we earn, the higher the tax rate. The purpose of income splitting is to legally spread the income across family members who may have a lower tax bracket than the main earner. So effectively, it will reduce the overall tax for the entire family. The first one is the prescribed rate loan. So assuming this one, the taxpayer is at the highest tax bracket, and perhaps the spouse is on a lower tax bracket, the taxpayer can lend the money to the spouse at the CRA pre-approved prescribed rate, roughly 3%, and it will pay tax on the 3%, and all the earnings from the investment, it will be taxed at the spouse's lower tax rate. One thing to keep in mind is the interest. It needs to be paid by January 30th of each year. Otherwise, CRA will cancel the arrangement. And also on the financial point of view, if the prescribed rate is 3%, the investment that we're making, it has to make more than that. And also, remember the capital gain is taxed at 50%. So the investment, it needs to double that for this to work. And just be mindful that if we're going this route, hoping to save money on the taxes, just make sure that we understand the calculations. It need to be at least at bare minimum more than the 3% the interest that we have to pay. The second point is the spousal RSP. So this one, the idea is the taxpayer will contribute to the spouse's RSP using the taxpayer's RSP room, and the gain from this part is the taxpayer instantly gains the tax deduction, and the spouse will only pay tax when they withdraw the funds, either at retirement or perhaps in a later year where they have a lower income. So effectively, we're transferring the tax liability from the higher one to the lower one and end up with a gain overall. One thing to be very mindful on this one is there is a 3-year attribution rule. So the taxpayer, you cannot transfer the money to the spouse and immediately in the next year, the spouse withdraw the money. The spouse has to wait at least 3 years. Otherwise, the tax will be at the earnings, it will be attributed back to the taxpayer, and they will have to pay the highest tax rates. Just make sure we're mindful of this. And also, this arrangement is irreversible. So if you contribute to your spouse's RSP and you later decide that it may not work as you intended and you want to reverse it, that's not allowed under CIA rules. The next point is the pension income splitting. So this one, the good thing is up to 50% of the actual pension can be allocated to the spouse every year with a joint election, T1032 joint election. The good thing is by doing this, the income is effectively split between the two spouses, and the tax perhaps could be lower. But things to keep in mind for this one also is by increasing your spouse's income, if they were at the lower tax bracket and they had a age amount, for example, that require them to be have annual income less than 45,000, and you as the taxpayer do the pension splitting and end up making their income more than that, there is a possibility that they will lose some of the credits that the CRA is providing them. So just be mindful of that. The other thing is not every income is eligible for pension splitting. Usually the RRF annuity payments, if over 65, they qualify. Regular RSP withdrawals, any active income, any employment income, old age security, these do not qualify for pension splitting. And of course, this option also doesn't benefit singles. The last point on this part is funding your spouse or adult child's TSFA, the tax-free savings account. The benefit of this option is there's no attribution rule within TSFA. So that means the money that is contributed to the TSFA, it won't be taxed back to the contributor, even if it's withdrawn within the 3 years, unlike the RRSP. The main reason for this is there is no upfront tax benefit in TSFA either, like the RSP. So therefore, they don't have this attribution rule. One thing to also keep in mind for this option is it is also irreversible. So once the taxpayer make this contribution to the spouse or the adult child's RS to the TSFA, and if something happens within the family dynamics or the relationship, you cannot legally force them to return the money.